Hello everyone, this is Orhan. In this video, I'm going to talk about market risk, beta, and security market line. There are two types of risks inherent in investments. The first one is diversifiable risk, which we already covered. It can be eliminated through proper diversification. And the second one is called market risk. It is the risks associated with the market itself. Market risk cannot be eliminated through diversification. It might include recessions, wars, terrorist attacks, earthquakes, natural disasters, etc. So when it happens, all of the stocks, all of the investments in the country are affected. So you can't get rid of that risk by diversifying your portfolio. Market risk is measured by beta, and it indicates how risky a stock is if the stock is held in a well-diversified portfolio. Let me illustrate beta using this example. In this example, there is RM, which indicates the market return, and RI, which indicates the stock return. Market return generally means market indices, for example, S&P 500 or Dow Jones Industrial or NASDAQ, etc. RI represents our stock's returns. When our stock is 18%, the market is 15%. Etc., etc. Every single year is a bundle, and every single bundle is represented by a dot on the graph. Okay, the first dot, third dot, and the second dot here. So this is called a scatter diagram, and any scatter diagram can be represented by a line. So this blue line is best representing these three data points in history. We are basically trying to find a relationship between our stock and market. That's why it's called a measure of market risk. So we are trying to understand how our stock reacts, what happens in the market. When market is 15%, our stock reacts as 18%. And when market goes down, our stock goes down too. Okay. So how much is the relationship between our stock and the market? So this equation represents that relationship, and it can be calculated by using any kind of software. Just to illustrate the point, assume, for example, that RM is 3. So multiply 3 by 144 and subtract 259, and you will get 173 here. Now let's increase RM from 3 to 4. When we increase RM from 3 to 4, which is 1 unit increase, RI is going to be 317, which is 1.44 increase. So this is not a coincidence that these numbers are the same. This is called beta here. Beta is the reaction of RI to 1 unit increase in RM. So when RM increases by 1 unit, RI is going to respond that by increasing 144. It also happens when RM decreases. So when RM decreases by 1 unit, RI is going to decrease by 144. So for the beta, these are the threshold numbers. When beta is equal to 1, the security is as risky as the average stock. If beta is higher than 1, the security is riskier than average, which was our previous example. If beta is less than 1, so the security is less risky than market. As an example, RI is equal to some alpha plus 0.8 RM. So this is here, beta is 0.8, which means that when market increases by 1 unit, RI is going to increase by 0.8 unit. Let's remember our example. In our example, the beta is higher than 1, which means that our stock in this example is riskier than the market. So beta measures the risk in the market. Now let me illustrate the point by using a real-life example. Here you see various beta of the investments that we covered before. The high-tech stocks beta is 131, which means that high-tech stocks are riskier than the market. And the T-bills, the beta of T-bills is 0, which means that there is no relationship with the market. And the beta of the collection is negative 0.5, which means that when market goes up, the collections respond in the reverse direction. Okay, when market goes up, collections goes down. When market goes down, the collections goes up. This table illustrates all of the expected return with the beta. So we already calculated these expected return before, and now we have their beta calculated. You can easily observe that when the expected return is higher, the beta is higher. When the expected return goes down, generally beta goes down, which means that the market risk goes down. Now let's take a look at a real-life example. I'm going to download the S&P 500 index and Walt Disney prices, and I'm going to show you how to calculate the beta using an Excel sheet. To do this, I'm going to use finance.yahoo.com web page. Here, you can write the S&P 500 in the search toolbar, and then you can click this GSPC ticker. And from here, click historical data, change the dates as you wish. I'm going to use 2-year data from November 2016 to November 2018, and I'm going to use weekly data. So when you make the necessary changes, hit apply and download the data. So once you download the data, open the Excel sheet and delete everything but the adjusted price and the date. And do the same thing for Disney stocks. Okay, write Disney here and download their 2-year data starting from November 2016 to 2018 and copy and paste the data. When you copy and paste the Walt Disney stock prices here, you will have this Excel sheet. You can find this Excel sheet beneath the video. So you can follow the steps and replicate what I do. Okay. First, you are supposed to calculate the returns of the index and returns of Walt Disney. So once you calculate the returns, you are supposed to select 2 columns and go to Insert. From here, select the scatter diagram and draw this chart. Once you have this chart, right-click on the chart and select Add Trend Line, and it should be linear here, and please select Display Equation on Chart and hit OK, and you're going to see an equation here, which will be our regression line. In this regression line, the coefficient of X represents our beta. So I can rewrite this equation as follows. Return of Disney is equal to 0.003 plus 0.89 times S&P 500. So the coefficient of S&P 500 is 0.89, is the beta of Disney. It is less than 1, which means the Walt Disney is less risky than the market. I did the same exercise using Bloomberg terminals. You can find this exercise in the next video, and you can compare the beta and you will see that they're exactly the same. Please note that the betas might change depending on the start date, end date, and the frequency. In this exercise, I am using 2-year weekly data. If you change the frequency from weekly to daily, the betas will change. In finance industry, conventionally, weekly returns are used. But in any ways, if you change the dates, if you change the frequency, you will have different betas. In this table, you see different examples of different companies. For example, Bank of America's beta was 1.8, Procter & Gamble's beta was 0.6 as of June 2011. If you change the dates, if you take a look at the beta of these companies now, you will see total different betas. Once we are done with beta, now we can take a look at security market line. Security market line shows the relationship between the required return for any stock and its beta. This is the required return for any stock, and this is the beta of that stock. If we know the risk-free rate in the market, if we know the market return, we can easily calculate the relationship. Assume, for example, that risk-free rate is 3% and market return is 8%. So this is 8%, risk-free rate is 3%. So this is going to be the required return equation for any stock in that market. Once you know the beta of any investment, you can calculate the required return for that investment. Now let's take a look at our previous investments. Remember that the relationship was RI is equal to 3% plus 8% minus 3% times beta. So since we already calculate the betas for high-tech stocks, market return, US rubber, T-bills, and collections, these are their corresponding betas, we can easily calculate their required rate of return. Okay? So any investor who is investing in high-tech stocks are requiring 9.55% return from that investment. Before, we already calculate the expected return for that investment. If the expected return is 9.9 and the required return is below that value, so this means that that investment is undervalued. The US rubber, for example, is overvalued. The required return is far higher than the expected return. So this is overvalued. If they are exactly the same, then they are fair valued. Now let's see these investments on the security market line. The security market line is R is equal to 3% plus 5% times beta. So on x-axis, we have beta. On y-axis, we have the return. And this is the regression equation of security market line. So any investment is going to be around this line. If it is above the line, it's undervalued. If it is below the line, it's overvalued. If they are on the line, they are fairly valued. Well, this wraps up our discussion about the security market line, market risk, and beta. I hope you enjoyed the video and hope to see you in the next videos.